Hello, everyone. It's very nice to be here with you all today. My name is Irena Radman, and I'm the head of U.S. listings at Nasdaq. As you can see, we have a very impressive panel ahead of us. Will indeed moderate the panel, but I will just give you a few minutes on the background of Nasdaq and our relationship with the shipping companies. Our goal at Nasdaq is to be a trusted partner for shipping companies offering trading support, investor intelligence, and marketing resources to help them navigate the U.S. equity capital markets with trust and confidence. Given our partnership approach, we are proud to be the home to 39 shipping companies, 29 which are listed here in our U.S. flagship, and the rest on our Nordic exchanges. Over the last decades, we've typically welcomed 2 to 3 new shipping companies annually, with standout years in 2006 and 2007, where we saw 10 additional listings, and again post-pandemic in 2021 with 4 new additions. That's why, just 3 months into 2025, we are absolutely thrilled to celebrate the record listing of not just 1, not 2, but 3 new shipping companies. Naturally, this sets our expectations high for additional listings this year. These 3 companies are on the next panel, represented by Tassos, Pankaj, and George, each of them highly experienced in the U.S. equity capital markets and well-versed in the incredible opportunities a Nasdaq listing can bring. Tassos being the CFO of 3 Nasdaq-listed companies, George alongside Akis having successfully listed 5 SPAC companies, and Pankaj leading 3 Nasdaq-listed companies to success. We value and take pride on the strong partnerships we have built with all of you, and we wish you all tremendous success. And now I'll hand it over to Will Vogel, partner at Watson, Farley, and Williams, to moderate the next panel.
Thank you, Irena. And hello, everyone. Can I be heard? Yes? Good. This is a very interesting panel for anyone interested in the development of shipping in the capital markets. As Irena said, each panelist here represents a recently listed company. I can say from experience that's not a small undertaking. Irena says there are many, average of 2 to 3 a year, but that's less than there ought to be by some measures, and the panelists here have an unusual depth of experience. So congratulations to all of you on the successful listing, and I thought we could start by asking each panelist to introduce their newly listed company and their role in it. So perhaps Tasso, you could begin.
Oh, thank you. And before I start, let me thank one more time Capital Link, Nicholas, and Olga for organizing this conference and inviting us all to participate. I represent today Euroholdings. Euroholdings is indeed a newly listed company on Nasdaq this month, 10 days ago. It is a spin-off of from its mother company, Eurosis Limited. And really the idea of spinning off Euroholdings is to spin off. We intended to spin off 3 of our oldest vessels, so 3 subsidiaries into Euroholdings, developing a separate strategy in how to manage and extract value from older ships. In the process of doing that, we ended up selling one of the ships, so we transferred 2 vessels and the proceeds from the sale of the 3rd one. We intend to keep Eurosis as a company focused on the feeder intermediate container ship sector, focusing again on new build ships and modern ships. We just completed a program at Eurosis of 9 vessels, a new building program of 9 vessels. We ordered 2 more, and we're pursuing a retrofit program of the remaining of our ships. And we thought that having a separate company for our elder ships, 25, 26, and 27 years of age, we can develop different investment and distribution strategies for each of the 2 companies. And we intend to pursue these strategies for separately Eurosis and Euroholdings. I'm not the CFO, I'm the Chief Strategy Officer. I couldn't be in CFO for more than 2 companies from Nasdaq, so I changed the role. But we intend to grow Euroholdings, pursuing both the older vessels strategy and potentially look for partners to grow that up. I'll stop here. We can talk more later.
Thank you. Pankaj.
Good afternoon. My name is Pankaj Khanna. I'm the CEO of Heidmar. The company has been around for 40 years, a new listing, but an old company. Survived in its private form for many years, has gone through various cycles. I bought out the company from my previous employer, George Economou, in November 2020. We started with 6 ships and 6 people. Today we are up to about 55 people, and we manage close to 45 vessels. When I bought out the company, what I bought was a very strong brand. There is very strong brand recognition of Heidmar, not just in the tanker industry where the company existed for 40 years, but in general in the shipping markets. So I combined my experience, my relationships built over the years with Heidmar's strong brand to rejuvenate the company and bring it back to the markets in a different form. Today, Heidmar is positioned as an asset manager. We don't just do tanker pools. That is one of the things that we do. But we are set up to basically manage assets for financial investors and strategic investors. So we can basically help an investor source an asset, manage the asset, whether that be in the form of corporate management. So we are doing the full legal setup, bank account setups, treasury, US GAAP, PCOB accounting, and then we do technical management and commercial management as well. In the past, we only did spot management in terms of trading ships on the spot market, but now we do time charters as well. So effectively, we're offering a full service. We do that on dry cargo as well now, so it's not just a tanker company. And it's not just for financial investors. We also have strategic investors, people who own MRs and want to invest in Aframaxes. There is a barrier to entry to go out and buy an Aframax and run the Aframax. So we are able to provide our expertise and wrap Heidmar around the investor to take them to the other market. And similarly, we are able to bring in dry bulk owners who want to invest in tankers and diversify. So we basically offer our expertise to do that. We listed last month. It's a new listing. We did a reverse merger to list the company. I've done or led or been part of 6 different listings over the last 20 years. This was probably the most difficult one so far because it's a service company. It's a small company. And the reverse merger process is not the most easiest process. We also went through a SPAC process earlier to get this thing done, which was unsuccessful. So I can tell a few stories about SPACs and reverse mergers, but maybe for later. The company is now listed on Nasdaq under the ticker HMR, and we have immense trading volatility and volume. So look up the ticker HMR. It's quite an interesting company. George?
Well, hi everyone. I'm George Syllantavos, the co-CEO and CFO of Stellar 5 Capital. We are obviously a SPAC. As I said earlier, this is our 5th SPAC. We just listed on the end of January 31. So we're about 2 months old. And we have a time frame to close the transaction or acquisition reverse merger of 21 months, so 19 months remaining. The ticker is SVCCU. This is a vehicle which is designed as a business combination vehicle, meaning a combination of the listed entity, the SPAC, which just has some monies in a trust account, and a counterparty through a reverse merger, that counterparty becomes public through a transaction, that M&A transaction with us. As we said, this is the 5th time we're doing this. The first 2 transactions were in the maritime space. It involved initially star bulk carriers, so star bulk carriers that you heard on the panel here before, or 2-3 panels before, the executives, was created through a reverse merger with Star Maritime acquisition at the time in 2005. So it's been almost 20 years since we've been in this game. Nobody remembers a star bulk is a de-SPACing outcome, but it sure is. We then went on and did a transaction in the offshore offshore maritime space with a company and with vessels that were serving offshore drilling platforms with Petrobras in Brazil. And we then pivoted to two technology transactions after that, just because of the market and the valuations of companies, maritime companies in those markets. Maybe that's all for now. And
yeah, thank you. I mean, each company has a unique proposition for investors that you've laid out in detail. But the follow-up question I wanted to ask, and I'll stick with you, George, if you don't mind, because I wanted to ask, what's the theory of the listing and its timing? I mean, this is not something that happens in shipping every day. It's difficult, as Pankaj said. And you have maybe the purest view on the market as a SPAC, right, with a 21-month time frame. Why now, essentially?
Why now as listing, you mean?
Yeah.
Well, listen, the SPAC product itself, it's a structured product, first of all. The SPAC product itself became very, very busy in 2020, 2021 to 22, meaning you had about 630 companies, SPACs out there looking for targets. So it became a very crowded situation with not enough targets to go around. So we actually waited for 2 years since our last closing, which was in February of 2022, to come back to market, just because we wanted that space to clear up. You have about 70 transactions out there now, vis-a-vis the 630 that were there at the end of 2021. So we feel it's first of all, it's a much safer, better environment to do a transaction. Second of all, through our maritime background, we are always looking for a maritime transaction, but such transaction is not always possible, just because where valuations are out there and because the investor, as you said, what are investors looking for? We issue stock at $10 a share. So the transaction we have to bring back to investors has to be worth north of $10 for us to get a successful closing, right? And money to stay in the trust, et cetera, et cetera. Now, that to happen, you have to have some positive private to public arbitrage in the transaction. Now, that private to public arbitrage was in place in 2006-07 when we did the Star Maritime transaction. I remember that we had 108% arbitrage that time. We were buying vessels at 4.25 times EBITDA, and the market was valuing it back then at 9 times. So it was a brainless transaction to do back then, because at time of de-SPACing, the $10 unit was worth 14-some bucks as in the common, and about 6.25 for the warrant. So that unit, that $10 unit back then was worth 21 bucks. So it was a brainless decision for an investor to say yes to the transaction, and 99.8% of our trust account remained with us.
Right.
We had just 0.2% redemptions, which I think were people that forgot to vote or something.
Incredible.
Something like that.
Yeah.
So, but this has changed now with shipping companies trading at a discount of NAV. It's very difficult, 70% NAV people are trading. So it's very difficult to tell somebody, okay, let's do a deal at $10, and then the next day after de-SPACing, your stock is worth $7. So it has been very difficult to do a direct vessel maritime transaction. There are other categories in the maritime world where we can do transactions, services, companies like Pankaj or energy logistics or logistics people or ports, infrastructure stuff. But right now it seems that it's difficult to do asset-heavy vessel maritime transactions in the de-SPACing phase.
Right. Would anyone else like to share a view on market conditions, including Irena? I mean, it may differ by your sector.
We figured that in parallel to that, we figured that as the regulations for emissions increase, people who would like to reduce their exposure in owning this type of vessels. Older vessels are typically in the less welcome category. So we figure there could be a niche. I mean, we need to validate that, but we figure that there could be a niche of companies that want to unload assets, take them back on charter for potentially, and we, having the expertise to run off ships, be able to extract some extra value for our shareholders by organizing this type of the spin-off. So that is really the motivation. We have registered significant interest of people who would be interested in transacting with our spin-off, and we'll see how this goes. We're not limiting the older vessel universe into the containers, although this is where we're starting from. Naturally, dry bulk ships is a very neighboring segment, but other segments as well might make sense for us to look at. I think that is really the motivation that drove us to do that.
For us, listing a service company in the maritime space is not easy. There isn't a huge demand for that out there in the public markets. That's why we have chosen a route which is, let's say, the back door into the listing, where we didn't IPO the company, we didn't raise any equity. What we were successful with was doing a reverse merger with a company that we carefully selected. The company had very high volumes of trading and also was a clean structure. With SPACs that we tried 2 years ago, you end up with a very expensive structure that has a lot of bells and whistles attached. And we did not like that eventually, and therefore we pulled the plug on that process. With the reverse merger, with a carefully selected target, you are able to achieve that listing in a much cheaper way than you would otherwise. And then also our motivation for listing was the fact that I wanted to grow Heidmar. The pooling business is changing. It's not the same as it used to be. If you look at the largest companies out there, most of them are associated with ship owners. So it's Maersk, it's Hafnia, it's Scorpio. And so I'm not a large ship owner. I started as a cadet on board a ship. I don't have the deep pockets that some of the competitors do. So I had to find a way to grow the company using the networks and relationships that I have, which for me is the US capital markets. I've been involved in this market since 2001 with TK. And this market offers an opportunity to raise capital. A lot of talk about large companies, $2 billion market caps. So maybe for ship-owning, asset-heavy companies, that is a consideration. But for a small-cap company like me, there is still a market out there which allows me to raise capital at the right time, given the right conditions, which the right condition being that you got to have volume. 2 weeks ago, the company traded 82 million shares on a given day on a $5 million float. The week prior our merger, the target company MGO traded 830 million shares on a 40-cent valuation, with a stock outstanding at the time probably was about 80 or 90 million shares. So if you can turn around your shares that many times in the market and have the volume, then you have the ability to raise capital. Then you have the ability to do something with your listing. If you don't have volume, then it becomes difficult. So this is what we think is an opportunity for Heidmar to be able to grow out there. And we see a need for the growth at Heidmar because we see a need for more outsourcing. Small ship owners in this market who are less than 10 vessels will face increasing difficulties because of decarbonization, the increasing complexity of trading, KYC requirements, etc. And there is room for us to provide a service in that market.
That you were able to achieve that volume without a capital raise is incredible. I wanted to talk about the structure, and thank you for opening the subject, Pankaj. The structure that each of you have chosen, I mean, in each case, it's something of a backdoor to the capital markets, and as Pankaj said, an alternative to an IPO. But we've got 3 instances here with a very different approach. I mean, I would say one thing I would observe about the structures that you each have chosen is that you're not doing your most significant capital raise up front. I mean, with a sort of a footnote for the SPAC being obviously having was it 150 million capital raise up front, but against the trend of mega SPACs, and I assume that it's likely that there would be pipe financing in the end. So in each case, you're deferring the capital raise as compared to a traditional IPO. I mean, that impacts how your transaction the company that results, you'll have a different investor base, you'll have different trading liquidity, but I imagine it smooths the regulatory path and reduces deal risk. Maybe you can talk about why you chose the structure you did, and George, maybe you could start by defending the SPAC structure.
Sorry.
Since
No, you have to be a little adventurous, that's for sure. First of all, I want to say that Pankaj had a bad SPAC experience because he tried to do it with the wrong people, so everybody understands that. But in any case, listen, we're not proponents of big SPAC raises. Just because the SPAC is a structured product and it has some structural elements in there that make it a little bit more difficult to do the right transaction from a financial engineering point of view. You have promote shares that need to be amortized in as big a counterparty transaction as possible. You have warrants there that you have to manage. It's a little... you have to be a little playful around all these issues in order to have a successful transaction. Now, we never want to raise too much money in a SPAC just because, first of all, there are redemptions in this time and age. And second of all, we have an internal rule that the counterparty that we transact with needs to be 3-4 times plus the amount of money, the enterprise value has to be the amount of money we have in trust. Therefore, although banks tell us, raise 250, 300 million, for us this means that we need to have transactions or counterparties we transact with that have an enterprise value of more than $1 billion, $1.5 billion. As the amount of money in a trust account, get bigger, the universe of targets shrinks. So that's how we look at it. So we try and raise the right size the SPAC and to ensure success at the end. So 150 million was a consensus raise between us and the banks. Now, the rest of the structure, I think it's a standard by now, having a unit with a common and either a warrant or half a warrant or third of a warrant. In our case, it's half a warrant. And the rest of the terms have been standardized these days for SPACs. So it's not that what we selected to do is just, this is what investors accept at this point in time. And so that's it.
I mean, it's hardly standardized. You have to be creative still with the terms, I think. And there have been new regulations put in the last year.
The regulations, we don't, the regulations are fine with us. We've been doing in this game for 20 years.
Yeah.
We have never had an issue with the regulator or with investors or with some action, against us or anything like that. So and to us, a little bit more stringent regulation in terms of what people are saying will happen, because the regulations came in when all these people were saying what will happen 3, 4, 5 years in the future, and then the results did not, come through. So for us, making that regulation a little bit tighter and providing a little bit more disclosure, it's not a problem. We welcome that regulation. As long as regulation is realistic and it doesn't impede on our ability to transact, regulation is fine.
Mm-hmm. Tasso, maybe I'll go to you next. Your spin-off was relatively small, I think 5% of your NAV or something like that.
That is correct.
Yeah.
We selected the more direct approach to list by just applying to SEC and Nasdaq to list. We put a small part, as you said, of our assets into the spin-off. It is a pretty clean structure, no debt, 0 debt. It has 50% of its asset in cash because of the sale of one ship, and it expects to have another 50% in contracted revenues and the scrap value of the other 2 ships. So in a sense, the idea was, and still is, that it will be priced better than the mother company simply because of the less of the shorter horizon looking forward. The ships are 26 years old on average, so how much longer they could live. They are contracted all the way to their next dry dock. Mm-hmm. So we were expecting and still expect to price near its NAV. In the beginning it did, later the price has dropped. But if it goes back near to NAV, which I'm sure it will when we first issue our quarterly results. We haven't really done a press release with earnings for the for the spin-off, then we could more easily use our stock as a currency, as Starbulk mentioned in the previous panel, to increase the size and pursue a growth strategy. So that is the idea behind it. Of course, being in a sector, in a shipping sector that is undergoing various changes, the emissions regulations being one that enforces certain regulations on ships, but also the technological regulation, having a company that is agile could allow us to potentially look at other maritime investors if they make sense.
The spin-off, I'll say, is probably from a regulatory and legal perspective the cleanest of these approaches. And like you said, a nice thing is that you get the parent company's investor base and that liquidity. That's something that you had in your structure as well, Pankaj, and you're achieving good volumes. But you said that this was a difficult process. I think you said more difficult than an IPO.
Yes, it is difficult. I have other people who are going through that process right now for more than a year through reverse mergers, where the reverse merger was not consummated because of the vote. They're going through other issues. Even for ourselves, the combination of the auditors in terms of how stringent they are with the reviews of the documents, the counterparty, the Nasdaq, and the SEC, you need to allow for way more time than you would have in the past. So in the past, people came to us and said, oh, you want to do a reverse merger, 6 months, you could be listed. Today, I would be shocked if people are able to do that in 12 months. Mm-hmm. So, the time frame required to get the structure done has lengthened because of various factors, and that needs to be taken into account if anybody is considering going down this path. Target selection is also a key matter because typically in this process, you are not dealing with companies who are, let's say, very public markets experience. So that can also cause complications in terms of how things pan out.
But all in all, less market risk or deal risk than an IPO. You don't have to price at the end.
Look, it cost me less than $2 million to go public. So I paid the price in terms of time, but I got it done in a cheap way. It's a clean stock. I have no debt. I have no warrants. I have no preferreds. And we are public with an amazing trading volume on the stock. So, it was a slog, but it was worth it at the end.
How many of the SPACs investors stayed in the...
So this was not the SPAC. This was the reverse merger.
Okay, sorry.
Yeah. And just to say what George said earlier, it was not so much about the people, but the timing. Yeah. At that point, 95, 98% of the SPAC investors were redeeming. So it did not matter what the company was. So the redemption rate was just too high. So no one would have stayed in that structure.
Yeah.
So I hesitate to ask this question because it's a perennial question and it's maybe unanswerable, so I guess you can each pass. But you're putting out relatively small listings and new listings, sort of cuts against a trend of consolidation and take privates among shipping public companies. And there's a perennial debate about valuation of shipping companies relative to NAV, the importance of perhaps size of the public company and liquidity. Does anyone have a view on that, or should we pass and move on to the next question?
Oh, I have some comments. I think
definitely
being public, we have another two companies that Euroholdings had a previous spin-off of its dry bulk fleet about 7 years ago. So
right.
Definitely being public creates an additional option. You can run your business as if it were private, but have the option, if the circumstances are appropriate, to raise funds in the public markets. People say that in some cases, half of the success is being there. So if you are there when there is this liquidity increase that Pankaj mentioned, there could be great opportunities, not only to raise money, but also to make successful transactions. Being public also provides a platform that other people might find attractive to transact with you. And in case of these types of potential mergers or ventures, being public also helps do the transaction faster and it's a little more because your structure is a little more transparent. So from our experience, we found only positive things about being public, despite the increased cost. We estimate it's between 701 million a year extra cost of being public, but it's a price worth paying to maintain the option.
Mm-hmm.
I think, having worked for companies that had assets, net asset value is really cold comfort for an investor. It has no meaning. The managements of the companies are never going to liquidate their companies, so it's a meaningless measure. Fortunately for Heidmar, I have no assets, so I have no net asset value. The only way you can value me is via EV/EBITDA. So you have to look at my cash flows and look at what we can do in the future, not just what we are doing right now. So I think that is something is reflected in our valuation. The company is today trading with a market cap of 180 million. I will not comment on the value, but for a company like Heidmar, there are people over here who know Heidmar for 20, 30, 40 years. It's not a bad place to be.
Well, on my end, I think, first of all, I'm a believer of the capital markets and what the access to capital of the capital markets can provide that type of support that the company needs to grow. Now, the other benefits for me, as I said, we're a structured product here, so it is whatever benefits the listing has for the counterparty that we transact with and who becomes public through us. For them, it's a way to become public in a shorter period of time, less costly time to actually list, although there are some other costs on the back end that sometimes we need to manage and in a better way, so it doesn't become too costly for the counterparty to list that way. But in any case, it's a faster, we view it as a faster, less costly way of becoming public. And also, in our case, because you implement an M&A agreement actually in that reverse merge and in that listing, we have the ability that other IPOs don't to have some earnouts structured there. So if the company strikes certain growth or other thresholds of the year forward, the year after that, we can structure in our M&A agreement some earnouts that are not possible when you just list an IPO and you do that book building and the pricing exercise in a regular IPO. So I think that's another benefit for companies that grow and have a growing plan and know what to do with their monies through that transaction, so they can earn more ownership in the company and more stock as they hit those thresholds going forward. So I think that's another attraction for our counterparties.
So we have only a short time left, but just as a final question, I mean, I'm often hearing from or speaking with management of private companies that are considering a public listing, and you hear concerns about loss of independence, flexibility, shareholders making their lives difficult. And yet each of you has successfully been in public companies and come back for more. Do you have any words of advice for anyone, perhaps about selecting board, management, the team? Anything?
I think if you have a proper governance and if the interests of the main sponsor or of management are fully aligned with the shareholders and there are no unusual transactions or unusual capital structure, you have nothing to fear from people who have an interest in your company. Mm-hmm. That is and another source of potential interest that has been lately noticed is because certain tribal companies especially trade below NAV, that creates an interest for people that have an interest in investing in the market to buy the assets via the public shares at a discount.
Yes.
That it's a welcome thing because it's going to bring the price closer to NAV, and management and the boards and the old shareholders have ways to deal with it if they don't like the new shooter.
Alignment with common shareholders.
I think that's the main thing. I think in all our companies, in our group, we have tried to align the interest of the main sponsor, the main shareholder with all shareholders, and have all of them in a pari passu basis, and that has worked very well so far.
Any other words of advice?
I would say that the motivation to go public should be right. I mean, it takes a long time to go public, it's difficult to go public, and then it's a lot of work once you are public. When you are private, you can take decisions very easily. You don't have to consider boards, shareholders. You don't have to respond to testy shareholders. So go public for the right reasons, and generally that right reason is to raise capital. If you're going to go public and not raise capital, then there's no point doing this.
Yeah, I generally agree with both. If corporate governance is right and you're doing things for the right things for the right reasons, then there's nothing to worry about. Alignment with the investor is important. So if you answer to shareholders' questions, and you have a little bit more scrutiny, so be it. That's the name of the game, right? If you didn't want that, you should have stayed private at the end of the day. So I don't see that as a problem. I actually, sometimes it's constructive because people have certain ideas, makes you think a little bit more and, and adjust and do something in a better way.
Thank you all for your insights. Thank you. I'm not sure where Nick is. Thank you.